I'm here with Brian Shannon of alphatrends.net. Brian, thanks for joining us.
Good to be here, Tim. Thank you.
So all the traders here are looking for a couple of things. One is, where do I set my stop losses? And the other is, where do I take my profits? How do I know where each of those are? For your personal trading strategy, how do you go about doing that?
Whenever I get involved in a trade and I'm determining, is there enough opportunity here versus the risk potential? Risk reward is what we all talk about. I ask myself two questions. Where has this come from and where does it have the potential to go? So if it hasn't really begun moving a lot yet, in other words, there's a pretty good level of support maybe underneath it for a long. And I'll just talk from the long here to keep it simple. If there's a pretty good support close by and I'm day trading 10, 15, 20 cents away, then I know that I can maybe go in a little bit heavier because my stop is going to be pretty tight. And if I look at it and say, where does it have the potential to go? Well, maybe it looks like the next potential level of resistance would be 50, 60 cents away so that I can get in heavy initially. When it gets that first burst of momentum, peel a little bit off just to reduce the overall risk in case the move fails. And then, so where does it come from? Where does it have the potential to go? And that helps determine where the risk reward will come into play.
And how about pivot points? I know those are important for you to watch as well. How do those come into play here?
Pivot analysis is, I think a lot of people understand now, is a mathematically based formula. It gives you basically 5 numbers. Some people have expanded out to 7 now, but the first level is known as the pivot. And it's based on a mathematical formula based on the previous day's range, high, low, and close, HLC. So it's based off that, and the pivot is a widely watched number by a lot of traders. Above that are 2 levels known as R1 and R2. Below the pivot are 2 levels that are S1 and S2. Now, you can go into the mathematics of it and all that, but what I like to look at is these are areas that a lot of people tend to focus on. So if I get involved in a stock, let's say I buy it, let's say the stock gaps up, it pulls back, it's holding above its daily VWAP, and it's holding above the pivot for the day. A lot of times that will continue to move higher when the buyers come back in. The first potential level that I look at, if there's no traditional prior support that might be resistance, I'll look at that R1, this mathematical formula that won't show up to people just looking at a chart without it. And I look at that and say, well, R1 is a level that a lot of people look at. So when it gets to R1, a lot of times what happens is traders will back off. They'll stop adding demand to the market. They won't chase it as much because they view it as, well, here's this potential level. And sellers will sometimes, myself included, will say, well, I'll offer a little bit out at R1. So what you have there is kind of a self-fulfilling prophecy around there where we have less demand or less aggressive demand and a little bit more supply entering the market. So that tends to be an area that the markets are kind of magnetized to because, again, that self-fulfilling nature, similar to what happens a lot of times with moving averages as well, the 50-day moving average. There's no magic to it other than that a lot of people look at it and it becomes a key inflection point for people to focus on.
Brian, thanks for your time today.
Thanks, Tim.
You're watching the MoneyShow.com video network.